Welcome back to Talk Nerdy to Me, a financial guide for entrepreneurs, where we dive deep into the financial issues that small to mid-sized businesses and high-growth companies face. And then we explore practical solutions to overcome them. I'm Michelle Delker, founder and CEO of the Stanley CFO Group. And today with me, and you can't see her snazzy menorah earrings, but is our Vice President of Operations, Robyn Keithley.
Hi, Michelle. Today we are diving deep into a topic every entrepreneur needs to have on their radar. Business taxes.
Oh my God, the level of excitement. This has to be residual like eggnog in her system because we've had Christmas and then also the first 2 nights of Hanukkah. Mm-hmm. So we are just like raring to go 100%. So taxes are one of the most significant and often most misunderstood aspects of running a business. But here's the thing, taxes don't have to be scary if you understand how they work and you plan ahead.
Right. In today's episode, we're covering what every business owner should know about taxes, common tax mistakes, the difference between processing and strategy, industry-specific opportunities, cash flow considerations, and IRS audit red flags.
Yes, not to be confused with IRS. So buckle up because this is going to be a comprehensive guide to making taxes work for your business, not against it.
Let's start with the basics. What every single entrepreneur needs to know about taxes. What's the first thing on the must-know list?
First and foremost, your business structure determines your tax obligations. So whether you're an LLC, an S Corp, a C Corp, your taxes are going to be handled very differently. Quick breakdown of business structures. Did you want to do a little? Okay. So LLC, limited liability companies, the profits pass through to your personal tax return and you'll pay self-employment taxes. S Corps, you can split your income between salary and distributions, reducing self-employment taxes. I mean, not a bad way to go. And regular C corporations, there's that double taxation where you're paying taxes on the corporate profits and then again on dividends as they're distributed.
And it's important to know that your business structure isn't set in stone. As your business grows, it might make sense to shift from an LLC to an S Corp or even to a C Corp. The decision can save you tens of thousands in taxes.
Gosh, sometimes even more depending on how big of a business you have. And I think that's a great point, just that in a life cycle of a business, you do have to stop, consider where you are, and potentially iterate. And then the second thing every entrepreneur needs to know, taxes are not relegated to the deadline. It's not a March or an April thing. It's a year-round responsibility. And if you wait until tax season to start thinking about your taxes, you are so far behind. Taxes should be built into your monthly financial strategy. I mean, you want to be setting cash aside regularly for estimated payments and planning for potential deductions.
And that brings us to our third point. Documentation is everything. If you can't prove your deductions, the IRS doesn't care how valid they are. They'll be disallowed.
That's painful.
Right. Good bookkeeping isn't optional. It's your defense against audits and your key to maximizing those deductions.
Which is great, right? Maximize the deductions. We're going to mitigate that liability and keep more cash in our pocket. So step 1, get your business structure right. Step 2, treat taxes as a year-round strategy. And step 3, keep impeccable records. So maybe now we should talk about some of the biggest mistakes that entrepreneurs make. And we see this a lot, right, when we start conversations, and that is mixing personal and business finances. A big no-no.
Oh, Michelle, we've seen this so many times. An entrepreneur uses one bank account or one credit card for everything. Groceries, software subscriptions, client dinners, it all gets mixed together.
Family vacations. They had a business meeting. Here's why it's a problem. It creates chaos for bookkeeping, first of all, which really understanding the financial position of your business, what it's generating is critically important, just in general. And then won't you exit one day? Don't you really need to know what your earnings, your seller's discretionary earnings are? Second, it makes it really difficult to track legitimate business expenses. And third, it's a huge red flag for the IRS.
But the fix is simple. Open a separate business bank account and credit card. Keep every business transaction in those accounts. And don't use them for personal spending.
Right. So my 2 crispy chicken tenders that I get at PDQ that come to $4.90 with my 2 honey mustard dipping sauces, that goes on my personal Amex. If you do ever accidentally mix up your cards and put a personal expense on your business card, you just need to flag it immediately and then document it properly. It's fixable. You won't catch on fire.
Right. And this one change makes bookkeeping easier, deductions clearer, and audits far less likely to become a nightmare.
Thank you so much for that. I think that was a really important one, but we're not done. There's another mistake.
Not more mistakes.
More mistakes. Ignoring quarterly tax payments.
This is such a common issue, especially for new entrepreneurs. Many people don't realize that if you expect to owe taxes for the year, the IRS expects you to pay quarterly, not just in March or April.
It's shocking, right? Mm-hmm. They want that money. What is it, J.G. Wentworth? It's my money and I want it now. They want it periodically throughout the year. And what happens if you skip those payments? You don't get a spanking, but you do get hit with penalties and interest. Which is not great. They'll charge you interest. Right. They're giving you a loan in their mind is what they're thinking when you don't pay on time.
Right. And then the solution, just calculate your estimated quarterly taxes based on your income and make those payments on time. And if your income fluctuates throughout the year, adjust your payments accordingly.
And we'll talk about that too, because a lot of times if you have like a transactional relationship with your tax partner and they're giving you your obligation for the year, that's just going to be divided by 4. A quarter, you say, and split into even payments. But in reality, we know we really want to match it with cash flow. Mm-hmm. So yeah, we'll talk about that. But also, as it relates to those quarterly payments, so it's not a surprise. What have we talked about? A 13-week rolling cash forecast. So incorporate those estimated payments into your forecast. That way you're prepared for the outflow and you don't find yourself scrambling because it's not a surprise.
Right. So these quarterly payments might not be fun, but they're necessary to remain compliant. Don't skip them.
I mean, I'm with you, definitely. It's like eating too much and then being scared to get on the scale. Don't worry, you've just got to face it, and then you can take action. All right, mistake number 3. I love this. The DIY taxes without strategy.
Listen, tax software is fantastic. It can file your taxes, crunch your numbers, and help you stay compliant, but it's not a substitute for a real tax strategy.
Exactly. So software, it's backward looking. It's about taking what's already happened and just populating it in the right box. But a tax strategist looks forward. They help you plan for deductions to optimize your structure and then to align your cash flow with your tax obligations.
We had a client who relied solely on DIY tax software.
Before we met them.
Yes, their return was accurate, but they missed out on $50,000 in deductions because they didn't know how to leverage certain credits.
Right. I mean, it sounds great, like pay $300 for your software and get it done yourself. But the right tax strategist doesn't just help you avoid mistakes. They help you find opportunities. If your business is growing or if your tax bill keeps surprising you, it's probably time to invest in professional help.
It's not an expense, it's an investment, and it pays off.
Love a good old-fashioned investment. All right, mistake number 4. I mean, we sort of touched on this, but poor record keeping. So it seems to be a recurring theme now.
It can cause so many headaches. If you can't back up your deductions with proper records, the IRS will disallow them, no matter how legitimate they are.
And let's be honest, nobody wants to be frantically searching for receipts in a shoebox at tax time. That's not something that's relegated to like the 80s. Like that right. Still happens. Good records aren't just about compliance. They're about maximizing deductions.
The solution, use an accounting software such as QuickBooks to keep your finances organized. And if you're not tech savvy, hire a bookkeeper to stay on top of it for you.
It's interesting because there are such great softwares out there that can help manage like segregating those expenses and tracking them appropriately. And you can store all of the underlying detail in the system. So you never have another shoebox. Oh my gosh, look at that. I'm right on script. Another tip, keep digital copies of every receipt and label them properly. The IRS allows digital records and they're much easier to store and search. Just a good practice in general.
Right. Clean books are a lifesaver. Trust us, it's worth the effort.
It really is. All right, so mistake number 5, not planning for big financial events.
This could be selling your business, buying a major asset, or taking on a huge new project. These events have massive tax implications.
So if you're not planning ahead, you could end up with a tax bill that's far larger than it needed to be, or you could miss out on savings opportunities entirely, and nobody wants that.
Right. The key here is communication. If you know something big is coming up, talk to your accountant or CFO ahead of time. Don't wait until tax season.
I agree. Communication, collaboration, it's the key. Taxes are complicated enough without adding any additional surprises into the mix. So plan ahead and you'll save yourself money and eliminate some stress. So next, tax strategy versus tax processing, what every business owner needs to know. So starting with the basics, what's the difference between tax processing and tax strategy?
So tax processing is essentially about compliance. It's preparing and filing your tax returns accurately, meeting deadlines, and ensuring you're following IRS rules.
Right. So again, processing is backward looking. It focuses on what has already happened. So if taxes were a car trip, processing would be the rear view mirror. You're looking behind you to report on where you've been. That's easy.
Exactly. Now, tax strategy is proactive and forward-looking. It's about planning for your taxes before you owe them, using legal tools and tactics to minimize your tax burden over time.
Yes. So if processing is the rear view mirror, strategy is the GPS. And I'm not talking about the Rand McNally that like dad would pull out, right? And mom would like whip out the highlighter. No, it's dynamic. It's ever changing. And it's helping you chart the most efficient course to reduce taxes and avoid unnecessary expenses along the way.
Another way to think about it is this. A tax preparer focuses on accuracy. They file what actually happened. A tax strategist focuses on optimization. They plan for what could be.
Yes. It reminds me, remember recently we had a conversation about the difference between accounting and FP&A?
Yes.
A lot of parallels there, right? What's already happened, the accountant, and then FP&A is sort of the crystal ball, but difficult to project what's going to happen if you don't know where you've already been.
Right.
So just the most important takeaway, processing without strategy really does leave money on the table every single time. We might have a case study to talk about. So why does tax strategy matter? Why isn't it enough to just file your taxes accurately every year?
Because taxes aren't just a compliance issue. They're a financial strategy tool. With a proper strategy, taxes can become an area where you actually save money rather than just an expense to minimize.
So yes, quick example. We had a client, a growing business, who had been working with a traditional tax preparer. Their taxes were accurate, but they were surprised every year by their final tax bill.
They came to us and we immediately noticed that they weren't taking advantage of a few key deductions and credits specific to their industry. We also noticed their quarterly estimated payments weren't aligned with their seasonal cash flow.
Yes. Right? Like they had crazy seasonality. And when it was time for them to make certain quarterly payments, it was a real struggle. So after implementing a tax strategy, we saved them a notable amount of money in taxes over the course of the year. And they were really excited and also a little confounded as to why that hadn't been done before, which is when we got deep into the conversation really about the processing versus the strategy.
Right. Here's another point. Tax processing is a cost. Tax strategy is an investment. You'll spend money on both, but one of them generates a return.
And we know it can be substantial. With the right strategy, you're not just reacting to taxes, you're using them as a lever for business growth, a lever or a trigger, whatever you prefer. So when do you need processing, strategy, or both? Now that we understand the difference, let's talk about when you need one versus the other.
Every business needs tax processing. It's non-negotiable. You have to file accurate returns and comply with deadlines. Whether you're a solo entrepreneur or a $50 million company, compliance isn't optional.
No, compliance isn't optional. And here's where strategy comes in. If your business is growing and you're seeing larger profits, or if your tax bills are starting to surprise you, that's when you need to start thinking about the strategy.
And if you're planning a major financial event like selling your business, buying significant equipment, or expanding into markets, strategy is essential.
So I think entrepreneurs need both, honestly, compliance and a plan. There's really no reason to be surprised. And our whole goal, everything that we do, is about optimizing the business. We always want to honor our commitment. Of course, we're going to do what's right, but we want to mitigate so we can preserve as much as possible.
Absolutely. Processing keeps you out of trouble, but strategy puts money back in your pocket. When they work together, that's when you see the magic happen.
You can see it. I love it. So the bottom line, every business needs processing, and growing businesses with complex structures, or those planning big moves, need strategy. I mean, I think everybody needs strategy. So strategy. So simple tax strategies every business owner can implement. Let's talk through a few that any business owner can start thinking about today.
Right.
Today, December, what is it? 27th, where we're like in a haze of, I don't know, cheese spread and bourbon.
Weird time of year, yes. Align your essential tax payments with your cash flow. If your income is seasonal, your payment should match your revenue cycles, not be flat across the year.
That's what we were just saying.
Right.
Yeah. So second, maximize deductions and credits. Work with a professional to make sure that you're claiming everything you're entitled to, whether it's R&D credits, equipment depreciation, or home office deductions. But be careful with that one.
And plan major expenses strategically. If you know you'll need a big piece of equipment, timing your purchase for maximum tax impact can make a huge difference.
Right? Like maybe buy it before the end of the year if cash flow permits and you have an obligation. And finally, keep your records clean. Good documentation isn't just for compliance. It's the foundation of any good tax strategy. And side note, the foundation of any good strategy. You can't do it without clean records.
Even these small changes can add up to significant tax savings over time.
Yes. All right. Maybe the sexiest of the bunch, and we've talked about a lot of really exciting things so far, but industry-specific tax opportunities. Are you leaving money on the table? Tell us.
All right. Let's kick things off with manufacturing. This is one of the most tax-friendly industries out there, but many businesses aren't aware of the opportunities they have. One of the biggest tax credits for manufacturers is the Research and Development, R&D, tax credit. Despite the name, it's not just for people in white lab coats developing new products.
Stop it. Do they have pocket protectors as well? Of course. Those are my people. If you're improving a product, refining a process, or even upgrading machinery, you might qualify for the R&D credit. It's not just for big corporations. Small manufacturers can absolutely benefit too.
Right. And another one is the Section 179 deduction. Favorite, which allows manufacturers to deduct the full cost of qualifying equipment purchases in the year they're made, instead of spreading it out over years.
Yes. And don't forget about energy efficiency incentives. If you've made upgrades to your facilities, like better insulation, LED lighting, or energy efficient HVAC systems, you might qualify for additional deductions. And it can even change like how much you can borrow through SBA, right? Crazy.
Manufacturers, listen up. Don't assume your accountant is catching all of this. Work with someone who understands your industry inside and out.
I love it. So that was manufacturing. Now what about real estate tax opportunities? Whether you're a property investor, a landlord, or a developer, the real estate industry is packed with tax savings opportunities.
One of the most significant tools in real estate is depreciation deductions. You can deduct the cost of property over time, even though in reality, your property might be appreciating in value.
Right. And there's also something called a cost segregation study. You know about that, right? This allows property owners to accelerate depreciation on specific components of a building, like lighting systems or HVAC equipment.
Don't forget about 1031 exchanges. If you're selling an investment property and reinvesting the proceeds into another property, a 1031 exchange allows you to defer paying capital gains taxes.
I love it. But be careful here. I've seen a lot of people rush into purchasing something else that maybe wasn't a great deal because they're trying to leverage that particular nuance. It's like, make sure you're still getting a good deal. Don't overpay. And lastly, let's not overlook green building incentives. If you've invested, I mean, we just talked about this, right? Efficiencies in solar panels, energy efficient windows, or other sustainable upgrades, you could qualify for significant federal and state tax credits.
Real estate tax planning isn't something you want to leave to chance. A proactive tax advisor can make a huge difference.
For sure. Or is it like faux shizzle?
Sure.
Okay. All right. So next up, technology and startup tax opportunities. And we've seen a lot of this. There have been a lot of changing regulations. So shifting gears, this is an industry where a lot of money gets left on the table simply because founders don't know what they're eligible for.
First up, let's talk about the R&D tax credit again. For tech companies, this credit is often underutilized. Whether you're building software, developing new features, or refining algorithms, you might qualify.
Not refining algorithms. Yeah. Oh, my goodness. And here's something many founders overlook, and that's the startup expense deductions. So in your first year of operations, you can deduct some of your startup costs, including legal fees, software, and marketing expenses.
There's also the qualified small business stock exemption. If you're a startup founder or early investor, you might be able to avoid paying capital gains taxes on the sale of your shares if certain conditions are met.
Oh, I love it. And let's not forget about state-specific tech incentives. Depending on where your company is located, there might be additional tax breaks or grants available.
Tech founders, if you're using generic accounting services, you might be missing out on thousands or even millions of dollars in tax opportunities.
It sounds crazy, but it's true. I mean, really, especially with some of the regulations that changed over the last couple of years, the way that items have to be evaluated, making sure that you're partnering with someone who really, number one, understands the crux of your business, and two, is comfortable with the changing regulations is key. Mm-hmm. Hyper-conservatism doesn't always help. All right, segment 4, construction and contractor tax opportunities. This is another industry with plenty of tax opportunities.
One big one is the Work Opportunity Tax Credit, or I like to call it the WOTC.
Yes.
If you hire individuals from certain targeted groups like veterans or long-term unemployed individuals, you could get significant tax credits.
I love that you said WOTC. It makes me so happy. People think we don't have any fun, but how do you not have fun when you say WOTC and when you've got your menorah earrings on? Oh my gosh. And contractors can also take advantage of the Section 179 deduction that we mentioned earlier. So heavy equipment, machinery, and even some vehicles can be fully expensed in the year of purchase.
There's also the domestic production activities deduction, which can apply to construction companies that build or approve property the good old USA.
You can call it the D-pad, but it's not as much fun as the WOTC. And let's not forget about fuel tax credits if you're using off-road equipment.
These opportunities can add up quickly, but only if you know how to look for them.
Yes. So again, work with a qualified professional. Make sure that you're collaborating frequently and that they really understand your business and the nuances associated with it. So let's move on to the connection between cash flow and taxes. So how are cash flow and taxes connected? It might seem obvious, but many entrepreneurs treat them like two separate things.
Exactly. Taxes are one of the biggest expenses a business owner will face, and they're also one of the most predictable. Yet so many businesses are blindsided when the quarterly or annual tax bill comes due.
Blindsided, right? And a lot of times just because there's not been that consistent communication. And this, again, is why it's important to have that open, honest back and forth, because we work with a lot of high growth businesses, right? So if you're looking at what you did last year and your practitioner doesn't have any idea that you're planning 50% growth, surprise! So the connection is simple. Taxes are a cash outflow. If you don't plan for them, they can disrupt your ability to pay all the things, suppliers, payroll, or even invest in growth.
Right. Think about quarterly estimated taxes. The IRS expects you to pay taxes in 4 installments throughout the year. If your cash flow isn't aligned with these payments, it can create massive stress.
For sure. So it's not just about having the cash, it's about timing. A profitable business can still run out of cash. We know this. We've had like 2 to 3 episodes specifically on how to optimize your cash flow for profitable and then for companies that are losing money. Mm-hmm. So yes, rewind, find those episodes. So if their tax payments aren't planned around their revenue cycles, that can create unnecessary stress.
And we've seen this with seasonal businesses. They might make most of their revenue in Q3 and Q4, but their tax payments are evenly distributed across all 4 quarters.
Yes, that is a mismatch and it can strangle your cash flow in slow months. Taxes shouldn't be an afterthought. They need to be built into your cash flow strategy. So put it into your 13-week rolling forecast, people. So now that we've established the connection, let's talk about some common pitfalls and how to avoid them.
First up, not setting aside money for taxes each month. If you wait until the end of the quarter or worse, the end of the year, you're setting yourself up for a cash crunch.
So don't take big fat distributions and go shopping. So a simple strategy is to set aside cash monthly in a separate account designated specifically for taxes. That way, when payments are due, the money is already there.
Another mistake we see is ignoring seasonality. If your revenue fluctuates, your tax strategy should account for those highs and lows.
It feels like we're really hammering on some points, right? I feel like
it's not just a number divided by 4.
Yes. So clean bookkeeping, that one really stands out. Timing of cash flow, planning, all of that. I feel like it's all coming together. I agree. Seasonal businesses, it might make sense to adjust quarterly payments based on when revenue and cash actually comes in rather than sticking to flat quarterly payments.
And finally, relying on tax refunds as a financial plan.
Stop it.
Did people realize a big refund might feel great, but it seems you essentially gave the IRS an interest-free loan?
It's so painful.
You gave them your money and they're just holding it.
Yes, it is so, so painful. Please don't do that. Instead, aim to get your estimated payments as accurate as possible because the goal isn't a massive refund. It's keeping as much cash in your business as possible throughout the year. So you want to talk about some red flags? IRS audit red flags in particular?
Okay. Just not random red flags. Got it.
No, there's a flag on that play. All right, let's start with some perspective. The word audit sounds terrifying, but the reality is most businesses won't ever face one.
That's true. According to the IRS, less than 1% of individual and small business tax returns get audited each year. But here's the catch. Certain behaviors and patterns can significantly increase your odds.
Yes, not that whole may the odds be ever in your favor. Is that what it is? What was that?
Something like that, yeah.
Something like that. Clearly, I am not up to date. But those behaviors, just to be clear, they're not always intentional. Many entrepreneurs trigger red flags without even realizing it. Sometimes it's just an honest mistake or a misunderstanding of tax laws.
The key here is to understand what the IRS is looking for. Audits don't happen randomly. They're often triggered by significant signals in your tax return.
So let's talk about those red flags. Grab a pen or a mechanical pencil because you'll want to jot these down. So first up is disproportionate deductions. This is one of the biggest IRS audit triggers.
Right. If your deductions are unusually high compared to your income, it's going to raise eyebrows. For example, if you're reporting $100,000 in income but claiming $80,000 in deductions, the IRS is going to want to know why.
And that's not to say you shouldn't claim legitimate deductions. Of course, you absolutely should, but they do need to make sense in the context of your income and business operations. That pesky old IRS leverages a lot of technology and they look at your NAICS code and compare that to what others are doing as well.
Exactly. And be especially careful with home office deductions, travel expenses, and meal deductions. These are areas where people often push the boundaries.
Do you mean that some people are putting their 2 crispy chicken tenders on their business card?
Yes, ma'am.
It's not me. So best practice, keep clear, detailed records. If you can't back up your deduction with receipts and documentation, don't claim it.
Remember, a deduction isn't free money. It's something you have to prove.
And a lot of people call these deductions write-offs, right?
Right. Just write it off.
Yes.
Okay.
What was it? On Schitt's Creek, David? It's a write-off. These sheets are a write-off. Oh, David. All right, red flag. Next up, inconsistent reporting. This happens more often than you think, and it really is a huge red flag.
Yeah, this is when the numbers on your tax return don't match the information the IRS already has from other sources like 1099s, W-2s, or bank statements.
Yeah. So cross-referencing, footing, and So if a client sends you a 1099 that says that you earned $50,000, but you only report $40,000 on your return, that's a problem.
The math ain't mathin'. Or if your income jumps drastically from year to year without a clear explanation, it might raise questions.
It is shocking, but the IRS really does have sophisticated systems to cross-reference data. If something doesn't line up, it'll trigger a closer look.
The lesson here, be accurate, be consistent, and double check everything before you file.
So like belted and suspended. So the next red flag, excessive cash transactions. Cash-based businesses like restaurants, salons, or retail are often at higher risk for audits.
The IRS knows that cash transactions are harder to track and easier to hide. If your business deals heavily in cash, it's important to have solid documentation for every dollar.
Every dollar. Dollar bills, yeah. So large cash deposits or withdrawals, especially amounts over $10,000, are reported to the IRS automatically by banks.
The best way to protect yourself, keep detailed records. Every transaction should have a paper trail, whether it's cash, card, or bank transfer.
And if your business deals with a lot of cash, transparency is really your best defense. Because for almost anything else, there's a statute of limitations.
Right.
Like if you make a calculation error, there's a statute of limitations. If your intent is to like intentionally deceive or defraud, there is no statute. All right. So next red flag, claiming business losses year after year.
The IRS expects businesses to make a profit eventually.
What?
If you're consistently reporting losses year after year, they might start wondering if your business is actually a business or if it's a hobby.
This is hysterical, right? So there's something called the hobby loss rule. If the IRS determines that your business is more of a hobby, you'll lose your ability to claim losses against other income.
This doesn't mean you can't have bad years, but if losses become a pattern, you need to have a clear explanation and proof that you're actively trying to turn a profit.
So if you're in this situation, work with a tax professional to make sure that you're handling your losses properly. Ooh, I feel like we just did a big workout. That was a lot. Have you broken a sweat?
Yes.
I'm schwitzing. So, we covered what you should know, common mistakes, processing versus strategy, industry-specific credits, and red flags. So after all of that, now you know. When it comes to taxes, there are so many different factors that you need to take into consideration. And having the right partner is going to make all the difference.
If you're ready to take your business to the next level, we're here to help. At the William Stanley CFO Group, we specialize in turning numbers into strategy and strategy into success.
Is adorable. If any of this conversation resonated with challenges you're facing, we'd love to explore how we can help. We specialize in creating transformational change and unlocking potential for businesses like yours. Visit our website, thewilliamstanleycfogroup.com, to dive deeper into our case studies and learn more about what we do. And be sure to check us out and follow us on social media, LinkedIn, the Gram, and Facebook, where we'll share highlights and actionable insights from this episode. And please don't forget to subscribe to us on Spotify. I think we now have 15 subscribers. We're here to simplify the complex and empower you to take your business to the next level. Until next time, keep nerding out with us. And as always, thanks for listening. Okay, bye.